In last week's episode, we covered how high-quality financial stocks could still have room to run. Today, though, we're digging into a story that's stirring up real concern in financial circles, and that is how cracks in the booming private credit market could ripple through regional banks, and maybe even shake the broader market. Now, before we dive in, just a quick reminder, you can read the full article at the link in the description. It goes into all the details that we don't have time for today, so it's definitely worth checking out. Alright, let's jump in. Two high-profile bankruptcies have lit the fuse on this story, First Brands and Tricolor. First Brands, a car parts company, filed for bankruptcy in September, and creditors got spooked by the sheer size of its liabilities. Just weeks before that, Tricolor, a car dealership and subprime lender, filed for liquidation after reportedly pledging the same collateral on multiple loans. What do these companies have in common? Well, they weren't relying on traditional banks. They were backed up by private credit lenders, and now those lenders are sitting on big losses. Add to that some fresh fraud allegations involving borrowers at Western Alliance and Zions Bank, and you start to understand why the KBW Regional Bank Index is down more than 6% this past month. So what's actually going on with private credit, and what can we do about it? Well, private credit's been around since the 1980s, but in the past 15 years, it has absolutely exploded. After the global financial crisis, regulators tightened the screws on banks. Stricter capital requirements, more borrowing scrutiny. In short, lending became more expensive and complicated. That's when private credit got more attention. These non-bank financial institutions, also known as the shadow banking sector, don't face the same rules, giving them more flexibility. And during the low-rate decade that followed the GFC, they were able to raise mountains of cheap cash. With help from firms like KKR, Blackstone, Apollo, and Ares, private credit assets under management has grown from $500 billion to a staggering $3 trillion. And the returns have been pretty impressive. Over the past decade, private credit has outperformed both leveraged loans and high-yield bonds with less volatility. No wonder investors are pretty keen on the sector. In just the first half of this year, wealthy US investors funneled $48 billion into private credit funds. Europe's catching on too, with evergreen fund numbers jumping from just 6 in 2022 to 37 today. And this isn't slowing down. BlackRock expects the market to hit $4.5 trillion by 2030. Private credit only makes up about 9% of corporate borrowing right now. That leaves plenty of room for growth, but also plenty of risk, especially when companies are staying private longer and bypassing traditional funding routes. And now, after those high-profile defaults, we're seeing the first signs of stress. First, banks themselves are actually exposed. As private credit ballooned, banks started lending directly to these non-bank lenders. About 24% of loans to non-depository financial institutions were to private credit providers. Essentially, banks are lending to shadow banks, who are taking on risk that the banks themselves wouldn't take. Second, institutional investors are piling in. Big players like pension funds and insurance companies are upping their allocations to private credit. That means more exposure to hidden balance sheet risk. And if there's a wave of defaults, you can probably expect market-wide reactions, heavy selling, contagion fears, and the like. Third, banks are quietly building defenses. Federal Reserve data shows banks converting highly liquid assets like treasuries into cash, likely to prepare for potential shortfalls. Some are tapping the Fed's overnight repo facility to shore up their liquidity. And it's not just smaller banks in the crosshairs. Fifth Third Bank, a larger regional player, recently posted a $178 million loss tied to Tricolor's bankruptcy. So here's the good news. For now, it does seem contained. The sky isn't falling just yet. Only about 15% of US banks have exposure to non-bank financial institutions. The fallout from First Brands and Tricolor is painful but not widespread for now. But that doesn't mean we investors should sit still. So here's the insight. Spot the risks and reduce exposure. Here's what you can do right now to navigate this landscape. 1. Know who's lending. Big banks like Wells Fargo, Bank of America, and JP Morgan were the top lenders to non-depository financial institutions in Q4 of 2024. If you want to limit your exposure, start by checking their involvement in private credit. 2. Diversify accordingly. You don't need 100 stocks to be protected. According to the CFA Institute, 15 large cap or 26 small cap stocks offer nearly full diversification. Spread across sectors and geographies, this can soften the blow of any single event like fraud or bankruptcy. And 3, use a screener. Our high-quality financial stock screener you can see in the article filters for companies with strong earnings and healthy balance sheets. As of now, there are 44 stocks that meet our criteria, with 8 new additions just last week. So, to sum up, private credit is booming, but that boom is starting to show some cracks. And those cracks could widen if defaults become more common or fraud allegations keep piling up. But as always, panic is not a strategy. Risk can be managed and good companies can still thrive, even in uncertain times. If you want to go deeper into this topic, make sure to check out the full article, linked to in the description. And if you found this episode helpful or you have any feedback for us, please let us know in the comments below. We'll be back next week with more market insights. Until then, invest well.